What an incredible week of property and economic data. In today's Property Insider video, Dr. Andrew Wilson and I discuss the latest Australian Bureau of Statistics figures on our housing markets, what's happening to unemployment, the jobs figures, and what all that means for interest rates and housing affordability. If you want to keep up to date with our property markets, please subscribe to this YouTube channel and click the little bell icon so we can notify you each time a new show comes out. What an incredible week of positive economic and property data. It started with the Australian Bureau of Statistics confirming how strong our property markets are, and it continued on with the fourth largest monthly decline in unemployment on record. There was a stunning fall in unemployment from 5.5% to 5.1% in May. Perhaps more importantly, underemployment is now quite a bit lower to what it was at the beginning of the pandemic. Now, this incredible jobs boom has unemployment on track to have a 4 in front of it sooner than we expected. And this has led the media speculating what's going to happen to interest rates, what's going to happen to inflation. Now, of course, all this positive data is great for our property markets because our economy experienced a V-shaped recovery, something we were all hoping for, but very few people were expecting. Well, what does all this mean for our property data? That's the sort of question I want to ask Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market. Hi, Andrew.
Yeah, good day, Michael. It was a good news week, and it's not that we didn't expect it to some degree, but it was better than expected.
Oh, yes, much better than most of the pessimists had come up with as well. Now, we always start with the auction clearance rates because it gives us a good in-time indication of what's going on. The previous weekend was marred with the Queen's birthday long weekend holiday in a number of states. So what happened just recently?
Well, it's a remarkable, Michael. It just shows no sign of slowing down. We're into the third week of June now. We should be starting to see an easing, particularly seller activity, but we're not seeing that at all. We had a record day for auctions any June day, any June Saturday, 3 weekends ago. We followed that up with an all-time record number of auctions for a Queen's birthday weekend. And then we broke the record on Saturday again for all-time number of auctions conducted on a June weekend. In fact, the number was starting to get up to the all-time monthly record numbers. It was quite extraordinary. So sellers are still coming out of the woodwork, or perhaps they're sellers that have bought previously that are now coming into the market. But some really extraordinary numbers of auctions. Michael, Sydney had over 1,000 auctions on the weekend. It wasn't that long ago when 1,000 auctions would have been a record. And here we are in the middle of June with that number of offerings. And Melbourne was extraordinary. Over 1,500 auctions were conducted in Melbourne on Saturday. Perhaps there was a little bit of issues about auctions having been cancelled and then reintroduced, but I'm not sure about that. I think that, again, it's just a reflection of a strong underlying seller and buyer demand in our auction markets. And the smaller markets also had some very big numbers as well. Over 100 auctions in Brisbane and Adelaide, and pushing up towards 100 in Canberra. But the remarkable thing, Michael, is you would have expected with these record numbers of auctions week in, week out, that we'd start to see some easing in buyer activity. Now, we have seen some marginal declines in buyer activity, and the clearance rates we were recording back in March, which were just plain crazy, are certainly well behind us now. But we're tracking at or above 80% in most markets. Sydney was above 80% again. Despite those 1,000 auctions, Melbourne picked up quite strongly with the clearance rate well over 70% compared to the previous weekend, and 80% clearance rates in Brisbane, Adelaide and Canberra, and well into the 80s, despite those high auction numbers. So plenty of seller activity, Michael, being matched by plenty of buyer activity. So the question is, when will this all start to slow down? We're a week away. We've got one more Saturday for the June winter market opener, and then we're into what should be the depth of the winter market, which is July. We've just got no signs of the market slowing down either from a buyer's perspective or a seller's perspective, and we can quite clearly expect to see higher prices as a result of these clearance rate results.
Clearly, when there's more buyers than there are good properties on the market and auction clearance rates remain around 80%, that's a sign that property values are going to increase.
Yes.
And over the last week, the Australian Bureau of Statistics released their data for the March quarter. It's old news now. We know that's 3 months away, but they confirmed what you at
Yes.
My Housing Market have been
Yes.
finding 3 months beforehand, that really our property markets are booming, and most markets are going to have double-digit growth this year.
Yes, and we may even see it getting up towards 20% in some of the top performers, Michael, which is quite not unprecedented, but about as good as it gets. But the consistency of the market is what's remarkable. All capital cities are experiencing strong growth, and likely all capitals will record prices growth over 10%. The interesting thing from the ABS data, Michael, is the ABS actually will report on the value of housing in Australia. So they actually put together a valuation model for the whole of Australia, come up with what the market's worth. And no surprise, it was $8 trillion, which is a new record over the March quarter, the value of Australian housing. But I think one of the interesting things was that the median value of a New South Wales property has now exceeded $1 million. So that covers all houses. And that's, obviously country areas and outer suburban areas, as well as the higher priced inner suburbs of Sydney. So it was a validation of just how strong this market is, Michael. But it is old news, as you said, and it'll only be a couple of weeks until we start looking at what the June quarter data is. And that will, of course, be higher again.
Well, your chart that we can see at the moment is showing the annual growth, but that includes a couple of bad months as well. So as we move forward, we're going to find that the bad months of 2020 are going to drop off, and there'll be even stronger annual price growth moving forward.
Yeah, that's right, Michael. And it is a market that's still being fueled by affordability. I mean, affordability, we're talking some pretty big numbers here and some quite obviously robust statistics. We've got to remember that the Sydney market is still just 10% higher than where it was 4 years ago. So it's just really tracked a bit above inflation now over that 4-year period. Perth just about where it was 7 years ago. Melbourne's up around 6% from where it was 4 years ago. And the Brisbane market only increased by around about 4 to 5% over a decade. So it didn't have the great booms that Melbourne and Sydney had, and previous to that Perth had. So in a sense, it's also catching up with its affordability relationship with other markets. But so we will get to the stage, Michael, don't worry about it, where we just can't afford to pay any more for property because the banks just won't lend us any more.
Well, it's going to affect certain segments of our demographics more than others. Clearly, some people are still going to have higher wages growth than others. If we look at the general economy, though, Andrew, it looks like it's raining jobs. Despite the relentless prediction of high unemployment, especially following the end of JobKeeper in March, Australia's jobless rate continued to defy the experts. We didn't fall off that cliff with the latest employment figures.
No, it was almost an irresistible temptation for those, like a quick headline, wasn't it, Michael, that we were going to jump off or fall off a cliff when JobKeeper finished. In fact, we've headed for the sky, haven't we? We've sort of done the reverse since JobKeeper ended. The unemployment rate's gone through the floor and jobs growth has gone through the roof. So it's been completely opposite to that sort of cheap headline chasing that we had for about 6 months. And a lot of those who comment on property also got sucked into believing that that would have an impact on house prices. It just shows you've got to be careful who you listen to and not make decisions based on cheap headlines. And I think most Australians don't do that anyway, which is a positive thing. But the jobs growth was very big as well, Michael, over 100,000 jobs created. And most were full-time jobs, which is another good statistic. But we're not alone in this, Michael. It's been a remarkable recovery from the COVID period in most advanced economies. They are seeing unemployment rates fall sharply. And of course, inevitably, we now have and inflation, of course, is bouncing back from those lows of a year ago. And we now have, of course, the inevitable narrative regarding interest rate increases. And I've had quite a few discussions regarding that over the last few days, various sectors. Of course, with a strengthening economy, with falling unemployment and rising inflation, the conversation should talk to when interest rates will rise. Even the US Federal Reserve Chairman, who started this sort of thing going, saying that, well, he thinks it's now 2023 rather than 2024. And I think another member of the board has said, well, it might even be 2022. Maybe they just love to see their name in the paper. I don't know. But we're still talking years, Michael. The speculation does come off the back of strengthening economy, but we're a long way short of higher interest rates now. And I think the biggest issue that we have, just to sort of flesh that out, Michael, is that even with higher inflation, what we really need to see is higher incomes. And it's that key relationship that will work its way into higher interest rates. Now, we are so far off higher incomes. Certainly, we're seeing this adjustment in inflation because prices were kept artificially low a year ago. So we are going to see a bounce back, a sharp bounce back. But that's not going to translate, in my opinion, into higher incomes. And if we get some entrenched inflation as a result of this adjustment process moving forward, the real horror here is that because we just don't have the capacity for higher incomes, we didn't have that pre-COVID, Michael. And I think that the recovery period might even act to keep wages down rather than up, because businesses will be really working hard to keep their cost base down. And that means putting downward pressure on income. So we may see higher prices, but flat wages. And that's a nightmare, because what it means is that real incomes will start to fall. And I think that's a bigger problem than interest rates, which we're just sort of cloud cuckoo land speculation at the moment. But I do think we've got some issues perhaps with real incomes falling, and that could have an impact, obviously, on the balance sheet of homeowners and mortgage holders if they're struggling to keep up with prices growth in a very flat income growth environment.
Moving forward, our borders are going to open as well, our international borders, and that's going to bring more skilled labour in, and that would dampen wages growth as well.
And that's the point, Michael. Wages growth was just 1.5% over the March quarter, and that came off of 1.2%, which are record lows. And we know that that's to do, so many people were on JobKeeper, and that pushed down the nominal wage position. And even coming back from 1.5, when we have getting back to the unemployment rate that we had pre-COVID, and we're still at 1.2, I can't see the environment to pushing up our wages as sharply as they fell during the COVID period. And that's the issue, is we are going to see higher inflation, absolutely, over the next 2 quarters, because we will be catching up with what was artificially low price environments last year. That may act to entrench prices as businesses maintain their profit levels with higher prices. They'll also use that environment to keep wages costs down as well. And as I said, I think the real concern for the Reserve Bank here is, of course, falling real wages. And that would be the absolute last thing they would want, even thinking about higher interest rates, because that would take even more money out of people's pockets.
Well, it's been all about jobs up till now with the government stimulus and lower interest rates. But now you're right, it's more about wages,
Yes.
not just having a job.
Yeah, absolutely. I thought we also had some other interesting data out last week, Michael. We had the population data was released for the December quarter from the ABS. And it really was fascinating. We obviously saw another huge fall in international migration. No surprise there. But as we've discussed here, the trend in terms of net interstate migration out of Victoria and into Queensland really did gather strength. There was another very steep decline in net loss of migrants from Victoria into other states, and another huge gain for Queensland from interstate migration. We know that the Brisbane housing market is particularly strong, and the Gold Coast housing market is particularly strong at the moment. The Gold Coast market is growing at the strongest rate of any major market in Australia at the moment, and that's being fueled, Brisbane and the Gold Coast, clearly by a wave of migrants coming out of particularly Victoria, looking for a safe haven perhaps. And of course, these are the December quarter data with more lockdowns in Melbourne and Sydney, restrictions happening, because I think there's a bit of COVID fatigue permeating its way through populations. I think that we'll continue to see that mass migration out of southern states into Queensland.
It works 2 ways. Not as only is their migration up, but people aren't leaving Queensland to go to Sydney and Melbourne for the big jobs either. So that's a combination of factors that's going to lead to more demand for our property market.
Look, the point is that when we talk about the overarching influence of interest rates on house price growth, Michael, which of course is eminently measurable, there's also another factor. When we have a flat interest rate environment, it then becomes about local housing market activity. Usually people trade within the price range of their local market. But if you're getting significant people moving into an area where they actually have a higher deposit because their properties are worth more in those markets, such as Melbourne and Sydney, it can act to push up prices. And we are certainly seeing that in some areas on the northern Gold Coast, where Sydney-siders and Melburnians have come into those markets, and they're cashed up from higher priced markets. And they're able to, in a market that's almost inundated with demand, they're able to push up prices quite sharply without it being an interest rate play as we normally see. So they can be a sort of another factor other than the movement in interest rates that can create very strong prices growth. And I think we're seeing that quite clearly as a result of COVID shutdowns, that exodus out of southern states into Queensland.
Well, when we get together next week, it'll be halfway through the year.
Yes.
What a 6 months it's been. Who would have believed it? But the best is yet to come, Andrew.
Well, there's no sign of this market slowing down, Michael, really anywhere. Easing perhaps at the margin. As I said, those clearance rates are now in the 80s, which not too long ago we would have been shouting, oh my, what a crazy boom this is. But we've come down from the 90s. So we can't use a word to describe that level of a boom, but it certainly has eased. But it's perhaps a little bit more of a rational market, but it's still a market that's well and truly in favour of sellers and has no sign of slowing down, Michael. And we will be the first to announce that. All right.
Well, it'll be interesting to catch up next week, and maybe we can look back on the first 6 months of the year.
Thank you, Michael.